Hi there, and welcome to this edition of Money Talks, where we take a look at all aspects of the rural economy as it affects you in the ag sector. Well, it's been another busy week. The Greek crisis continues to take a toll, with volatility still a major concern in Europe. The Crayfer saga is still playing out, with news that controversial investor Mei Wang may be barred as a company director. And Fonterra takes a fall for the second month in a row in their latest online auction. Joining us first in the studio to talk about all that and much more besides is senior economist Chris Tennent-Brown from ASB. Well, Chris, looking at our currency over the last week, how has it been treading?
It's been pretty choppy, John, with all this uncertainty offshore. We're seeing global sentiment wax and wane with each development coming out of Europe. And the New Zealand dollar tends to bob around on that sentiment. So compared to the levels we're at in April and early May, the New Zealand dollar against the US is down quite a bit.
Yeah, it's taken quite a wallop, hasn't it?
Yeah, it has, which is helpful for exporters. One cross rate that we've picked up on a little bit is the Australian cross rate. We were down in the high 70s on that rate. Now we're up into the early 80s with the Reserve Bank.
81.5, I think, when we came into the studio this morning.
That's it, and helping that cross rate is this thought that the Reserve Bank of Australia is going to pause with their interest rate tightening cycle, whereas the RBNZ's about to begin, and that narrowing interest rate disadvantage we've got to Australia, as that narrows, we should see the New Zealand dollar pick up just a little bit on that cross rate.
Why do you think the Reserve Bank of Australia is just staying stumm, so to speak?
Well, they've done a lot of work. They've got their interest rates away from the emergency settings that most central banks had slashed rates to in the global financial crisis, and they've got them back to what you'd think was neutral or roundabout average.
What are they sitting at?
Well, they've got their mortgage rates there are now sitting around the 7 mark, which is round average, and that's coming off the back of a cash rate which is 4.5%.
Right.
Now that's lower than what we've seen in the past, but one of the consequences of the financial crisis is that with the actual Reserve Bank's cash rate, they're getting higher effective mortgage rates because of the more expensive funding that banks are exposed to these days.
Now, are we likely to remain high against the US, although I know we've fallen back a little just recently against the US, but the US, the pound, the euro, are we likely to remain relatively high against them for a while yet?
Yeah, I think we will. The thing which takes that it'll take to really belt us down to low levels is another real wave of concern about global growth. We had that massive dip a couple of years ago when the global financial crisis was really at its peak and people had really terrible outlooks for global growth. That's the sort of thing it takes for our currency to get really weak, and I don't think that's going to happen. So we're likely to stay pretty strong against those economies that aren't performing quite as well as us. So in particular, that's the UK and Eurozone, which is a bit of an issue, particularly for the lamb exporters, because that's one of their key areas of focus.
Absolutely. Just with the US though, can you see us going back over 70 anytime soon?
Well, I think the test there will be if the Reserve Bank starts hiking rates, and again, assuming that this European situation doesn't turn out to be something more sinister than what it looks like at the moment, we think the Reserve Bank of New Zealand will start tightening the OCR, and that'll probably see us get back up into the early 70s against the US dollar over the next 3 or 4 months.
Yeah, so you've just released your foreign exchange forecasts. So you'd stick with that, what you've just been telling me in the relatively short term, but looking a bit further out, what are those forecasts showing?
Well, we've got the New Zealand dollar staying pretty strong, which goes hand in hand with our forecast for pretty reasonable commodity prices. It's hard to get a weak New Zealand dollar when the outlook for commodities is so reasonable. So we're not going to see the sort of situation where we get back down into the 50s against the US dollar, as long as we see things like beef and dairy prices trading around the current levels.
Now, let's turn our focus to the equity markets. I believe global equities have fallen about 12% since May. Is that right?
Yeah, they've really come off. And the thing to remember with equities is they have come an awful long way since around March last year. And we were pretty worried back at the beginning of 2009 that things were going to be quite bad. And then we started getting some good news and share markets rallied really hard.
Yeah.
So we've got a dip at the moment.
Yeah, it's not looking too healthy at the moment.
It is a big deal when you get markets pulling back by 10%. But in some ways, what was surprising was the strength and smoothness of the rally since March last year.
Yeah.
So again, it's a little bit like the European situation. Sure, it could turn into something more sinister, but as long as we've got good things going on in the world, like a slow recovery in the States and a strong performance coming out of Asia, there will be good opportunities for companies and shares can continue to perform well. But in the meantime, we've got a correction taking place which will chill investors' nerves a little bit.
I bet it will. Now, let's just take a quick look at the dairy sector. Fonterra just had their latest online auction overnight. How did that fare?
Well, prices coming back about 3.5%. And again...
Is that very significant?
Well, it seems like a big deal. We've had 2 negative months in a row, but I tend to focus on the positive. And when we had months when dairy prices raced ahead in the 10-20% sort of levels, to only be pulling back by these amounts is pretty pleasing, really. And dairy prices are still far stronger than what we would have been picking a year ago. So they're in the range, I think, where dairy farmers should be feeling pretty happy about things. The concern to keep an eye on over the next few months is really the outlook for growth for the key areas where we're sending dairy. But at the moment, the prices are certainly looking pretty reasonable.
Well, nice to hear an economist being positive for once, Chris. Well, thanks very much for that. Next up is BNZ Professor of Finance David Mays from Auckland University, who joins our panel to discuss the business headlines making the rounds over the last week. Welcome back. Well, David, you've been listening to what's been said. Anything particularly you'd want to add, particularly as regards the currencies? Well,
I thought that was a very fair assessment. I think the balance is between the effects from what we do here and the effects from what happens elsewhere. And we're at this stage when it's really what's happening elsewhere which affects the currency rates. So we're seeing that there's the uncertainty about what's going to happen in Europe, and that's probably having a bigger effect on us than any uncertainty about what the Reserve Bank's going to do here next. So I think people are fairly confident about what it's going to do because they've given some pretty clear signals.
Now, the topic which has international markets looking like possums caught in the headlights at the moment and wondering where things are headed, of course, is the Eurozone. Obviously, there's going to be continued volatility, but can you give us a thumbnail sketch of the factors behind the turmoil that's happening in the Eurozone at the moment, David?
Well, I think what's happened is that the Eurozone's always had some weaknesses in some countries, but the whole idea of the Eurozone was to try and correct those weaknesses. So the idea was that you would get discipline on the fiscal side, which would mean that countries would have relatively small deficits, supposed to be below 3% of GDP, and they'd have debt which was declining towards 60%, although in some cases it was starting around about 100% of GDP. And so it was designed to get them to get better and better every year, at a fairly slow rate, about 0.5% a year.
Right.
And what's happened, of course, is that they've now had a really bad shock, and some countries have therefore had to increase their debt very considerably. So instead of getting out of the danger zone, they got back into it. And people are just worried about what's going to happen. Will they be able to solve it or not?
Now, one commentator has theorised there's actually quite a bit of national psychology behind all this turmoil, that the Germans are over their war guilt well and truly and think Southern Europe should be following in their thrifty ways. Clearly, the Mediterranean countries haven't done that. Could German resentment over having to bail those countries out lead to the end of the euro, do you think? It could get that drastic?